Welcome to F9 Financial Management. This is the first video in this course, and I will go over the nature and purpose of financial management. So what is financial management? Why is it so important? And why should you learn how to manage an organization's finance? Financial management is the efficient sourcing and use of financial resources to ensure the objectives of the organization are achieved. It includes both short and long-term sources of finance and short and long-term objectives. The purpose of financial management is to create wealth for the business and its shareholders, generate income, and provide an adequate return on investment when taking the risks into account. It involves decision-making in the following key areas: investment decisions on projects that are long-term investments in non-current assets, for example, like a factory, and short-term investments in working capital, for example, ideas for reducing debtor days and increasing cash available. Finance decisions on where the money's needed to run the organization, so the working capital, and to invest in projects can be sourced. The impact and risk of gearing must be considered when making financial decisions. Dividend decisions need to be made about how shareholder wealth should be increased, through a high dividend or by reinvesting cash funds and increasing the value of the shareholders' shares. The financial impact of these decisions on the company value must be considered. Risk management in the company. This area examines the financial risk from exchange rates and interest rate risks. Financial management is a long-term activity involving a long-term view of raising finances, controlling resources, with the objective of achieving an organization's goals. For example, the investment decision to build a factory is one that spans many years. Management accounts are prepared to give information on daily operations so short-term decisions can be made. Management accounting timeframe is much shorter, with organizations preparing them on a monthly or annual basis. There is no standard management accounting format, and businesses will change their format to reflect the information needs. The information needs of management accounts are like those of financial management, and management accounts can be used to monitor and assess the organization's financial management. Both financial management and management accounting are used to ensure the resources are used to achieve the organization's objectives. Financial accounting, in contrast, gives a historical view of the company. It is also used by parties external to the organization, such as government bodies, potential investors, and financial institutions. It does not provide detailed information for operational decision-making like management accounts. The financial accounts are usually prepared on an annual basis and give an overview of the position of the company. They are important when seeking external sources of finance, such as bank loans or private investment. The format of the financial accounts is set by international standards, and financial accounts usually must be produced annually under company law.
Hello. In this presentation, I'm going to look at the role of financial management and, in particular, the central role played by financial management objectives. Specifically, this presentation will cover the role of financial management, financial objectives, financial decisions, financial constraints, and not-for-profit organisations. Let's look at each of these in turn. The role of financial management. If you are asked to define management or what managers do, you are likely to come up with terms such as control, decision-making, coordination, resource allocation, motivating employees, etc. Whilst these are all valid terms, what do they actually mean? In other words, what or how do we control? How do we know what decisions to make, etc.? Returning to the original question, therefore, all of the terms defined above combine to guide the organisation towards a predetermined outcome. In other words, an organisation cannot think about management until it has identified what it is that it is trying to achieve, i.e., what its objectives are. In the context of financial management, before we can consider the types of decisions that financial managers have to make, we must determine what our financial objectives are. Financial objectives. Firms will usually have a number of objectives, and these are often characterized as primary objectives, the reason for existing, and secondary objectives, the actions which promote the achievement of the primary objectives. For example, improving staff morale may be a secondary objective if it is believed to improve customer service and therefore the profitability of the organisation. Putting that to one side, the primary objective of a profit-making organisation is usually assumed to be the maximisation of shareholder wealth. Maximisation is not ideal in that it is very difficult, arguably impossible, to know when something is as good as it can possibly be. In practice, companies will aim to increase shareholder wealth by a level that is acceptable to them, and this aspect is considered in the cost of equity presentation. Notwithstanding this last point, the maximisation of shareholder wealth can be achieved either by increasing the company's share price or by paying out a dividend. The success or otherwise in achieving this objective can be measured in terms of total shareholder return, which is the dividend yield plus the capital growth, both expressed as a percentage. Dividend yield equals the dividend paid in the year divided by the share price at the start of the year. Capital growth equals the movement in share price during the year divided by the opening share price at the start of the year. Financial decisions. In an attempt to achieve the objectives, financial managers have to make a number of decisions. These can be categorized into three groups as follows. 1. Financing decisions as to how the company will raise the necessary finance. This is considered in the sources of finance presentation. 2. Investment decisions as to where the company will invest the finance raised. This decision can itself be split into three categories, namely working capital, investment appraisal, the improvement in the infrastructure of the existing business, and company acquisitions, the purchase of new businesses. 3. Dividend decisions as to whether companies should reinvest profits earned, referred to as internal finance, or distribute them to shareholders as dividends. Whilst these decisions have been defined individually, it is important to remember that in practice they will impact on each other. For example, the cost of raising finance discussed in the weighted average cost of capital presentation will be a major consideration in determining the viability of an investment appraisal considered in the NPV presentations. Financial constraints. So far we have described how financial managers will make decisions that it is hoped will guide an organisation towards the achievement of its predetermined objectives. It is important to remember, however, that managers' ability to do so freely will often be constrained by other stakeholders who have their own objectives for the company. Examples may include governments may impose regulations around health and safety concerns, or refuse to allow acquisitions if they see them as reducing competition. Banks may impose restrictions, referred to as loan covenants, in an attempt to ensure that loans are repaid. For example, they may limit the size of dividends or restrict the amount of other borrowings. Managers themselves may have their own agenda in terms of their own pay and perks or popularity. This is referred to as the agency problem and may be overcome either by good corporate governance or by incentivizing them in a way that benefits shareholders, for example, share options. Not-for-profit organisations. So far, this presentation has assumed that all businesses are profit-making, or at least trying to be, and that they aim to maximise shareholder wealth. Clearly, this is not the case. Many organisations are non-profit-making, and often these will not have shareholders. Examples will include central and local government, public sector organisations, for example schools, hospitals, etc., charities, and so on. This certainly does not mean that finance is unimportant. Indeed, arguably, finance becomes even more important simply because the amount of finance is limited. It may also be the case that there are limited opportunities to raise finance. For example, schools cannot issue share capital, etc. For this reason, it is essential that any money they do have is used well. This is often referred to as demonstrating value for money and is measured in terms of the 3 E's: economy, efficiency, and effectiveness. Economy refers to obtaining inputs of appropriate quality at the lowest price. Efficiency refers to maximizing the outputs from any given quantity of inputs, and effectiveness refers to the achievement of organizational objectives. As with the 3 decisions outlined above, financing, investment, and dividends, again, it is the interaction of the 3 E's that is important, and in particular, achieving an appropriate balance between them. Thank you.
Welcome to F5 Financial Management. In this video, I will go over the stakeholders and impact on corporate objectives. A stakeholder is somebody who has an interest in the business. It doesn't have to be a financial interest. With such a broad definition of stakeholders, there are many in a business. Let's look at a few found in most businesses. Ordinary shareholders are also called equity investors. They own the company and take on the most risk. Shareholders are taking a higher risk by investing their money in a company rather than leaving it on deposit in, say, a bank. Therefore, they expect a higher return than the returns offered by risk-free investments. Their main objective is to maximize the value of their investment, be that through dividend income or increasing share value. They have long and short-term objectives. The organization's directors. They manage the company on the shareholders' behalf. Their short-term objectives would be profit maximization, leading to increased bonuses, and in the long term, fending off takeovers. The organization's employees and the trade unions that represent them. Their objectives are fair salaries and safe working conditions in the short term. Job security and pensions would be a long-term objective. Customers. They want a quality product or service that gives value for money. Suppliers' short-term objectives are to supply the organization and get paid on time. Their long-term objectives would be to build long-term relationships and get repeat custom. Finance providers. Their objective is to get the loan they made repaid in full with interest. They are interested in the organization's ability to generate cash for this repayment in the short and long term. Government agencies. Their interests are many. They want to ensure that the organization is following the relevant legislation such as tax, employment, health and safety. The government also has an interest in the organization's employment levels, encouraging these and motivating the organization to increase its exports. The community at large. This is a broad stakeholder. Their objectives is that the organization has a positive impact on its surrounding community and environment. There can be conflict between the stakeholders of an organization because their objectives can be competing, and it is not possible to meet all the stakeholders' objectives. For example, between shareholders and directors, shareholders want to maximize their investment and may not agree with the directors' methods or their salaries, which are decided by often an independent remuneration committee. We will look at this conflict in the next slide. The organization wants to maximize its profits, and salaries are expenses that eat into these profits. Another conflict that would arise between staff and the organization. Other conflicts arise when it does something that is unpopular in a community. For example, a business wants to build a factory in a green space. Local community groups protest because it is ruining the landscape and increasing pollution in the area. The local government welcomed the decision, however, because it provides jobs. Agency theory. As I said, the owners of the organization are the shareholders, but often they don't manage their businesses. This is done by the directors. The director's job is to act in the best interests of the shareholders. However, they may not always do this and could act in their own best interests. For example, deciding to maximize short-term profitability, so they will receive higher bonuses at the expense of long-term growth for the organization, and higher share prices in the long run for shareholders. Agency theory deals with problems arising due to the competing objectives between the principal and the agent, i.e. between the shareholders, who are the principal, and the agents, who are the directors. To avoid agency problems, the objectives of the shareholders and the directors should be aligned. This can be done by basing the directors' bonuses on the organization's net profits and relating the directors' pay to their achievement of the shareholders' objectives. However, beware, because sometimes focusing solely on the short-term net profits can encourage short-term thinking on the director's part. Another option is also to give the directors share options in the company. By giving them share options in their remuneration package, they now are shareholders and their objectives are now in line with the shareholders. Measuring corporate achievements. The main objective of most organisations, as I've said, is to maximise shareholders' wealth. The directors need to put a plan in place and targets to chart the progress of the organisation. But how can they measure their progress? Progress and achievements are measured by looking at the following ratios: return on capital employed, return on equity, earnings per share, dividends per share. You should already be familiar with some of these ratios. Please refer back to F3 ratios if you want a quick refresher. Now, let's look at an example. These are the financial statements of Top Dog Inc. for the years ended 20x7 and 20x6. How do you get good at calculating ratios in your exam? By practicing. Please pause this video and calculate the return on capital employed, return on equity, earnings per share, dividend per share. Have you done them? Okay. So starting with calculating the return on capital employed. This ratio is very important to investors because they can assess how much profit is being generated for the amount they invested. It can be used to compare the returns offered by different companies. The formula to calculate it is profit before interest and tax divided by the capital employed, and then getting the percentage. Capital employed is measured as equity plus interest-bearing finance, so long-term loans plus share capital and reserves. Here you can see 20x7 and 20x6 return on capital employed. So for every $1 invested, the shareholders are getting back about 6% in 20x7 and 5 cents in 20x6. I am assuming that no accounting policy changes have occurred during the year, so I can compare them. The increase is a good indicator. The organisation will use this ratio to assess their efficiency at converting revenues into returns for their investors and to measure their progress towards their target return. They can also benchmark against other organisations in their industry. Shareholders will look at the return offered at Top Dog and what risk-free investments are offering, and the returns offered by other companies. The return on equity is calculated by dividing profit after tax and dividends by ordinary shares and reserves. Top Dog has no preference dividends, so we can just take the profit after tax. Again, we can see that the return on equity has increased slightly. This ratio measures how much profit a company generates for its ordinary shareholders with the money they have invested in the company. It is similar to the previous return on capital employed, only profit after tax is used rather than operating profit, and it looks only at the equity invested, whereas the return on capital employed also took debt into account. As you can see, Top Dog took on long-term debt in 20x7, so it is more geared than in the previous year. This impacted the return on equity, which is sensitive to the gearing. Directors may feel the return on equity does not reflect their achievement to maximise shareholders' return, as the profit after tax is used and tax rates are outside their control. Also, solely looking at profits, like with the return on capital employed, is a very short-term viewpoint to take, and long-term investments that grow shareholder wealth may be ignored. The return on equity ratio is useful to benchmark against similar companies who are applicable to the same tax laws. Earnings per share. The earnings per share are calculated by dividing the profit after tax and preference dividends by the number of ordinary shares in the company. The result is the amount of profit per share. For Top Dog, this increased to 40 cents a share in 20x7 from 33 cents in 20x6. This increase is good and reflects the increase in profits. However, it does not reflect the actual earnings received by the shareholders. It just shows the shareholders' share of the profits after tax. Earnings per share is not a useful comparison tool to compare other companies. However, the growth in earnings per share is something that can be compared. Dividend per share. This is calculated by dividing the total ordinary dividend by the total share capital issued. If there are any special one-off dividends paid in the year, these are deducted from the dividend figure. Topdog did not issue any special dividends in the year, so there is no deduction, and we see that the dividend has increased dramatically. In 20x6 it was 10 cents a share, and 20x7 it was 25 cents. The dividend in Topdog increased by 150%. This is a huge increase. Investors want to see a regular dividend, and because the companies are reluctant to increase dividends, even for a particularly good year, because they may not be able to sustain it during leaner years. Therefore, by increasing a dividend, this sends a good message to shareholders that the company believes that its current profitability and dividend, which is increased, is sustainable. This would cause share prices to increase. If a dividend rates were to fall, then this would send a negative message to shareholders, indicating that profits are reducing and the company does not see the situation improving in the foreseeable future. This would cause the share price to fall. A lot of planning and forecasting goes into the dividend policy. An organization's dividend policy depends on its shareholders' profile. Some shareholders don't want to receive a regular income from their investment, instead wanting the money to be reinvested in the organization, which will increase the value of their shares. This could be due to higher tax rates on dividends versus the capital appreciation on their shares. And some shareholders invest in shares to generate a regular income. Shareholders will look at companies' dividend policies in the past and invest in it if it matches their needs. So changes in the dividend policy can cause shareholders to sell their shares and invest their funds elsewhere. This can cause share prices to fall and leave the company open for a hostile takeover. The company's dividend sends a message to the shareholders, and it should be a consistent one. A shareholder's return on investment is made up of the dividends and capital gain on the value of their shares. How do we measure it? Let's say the share price of Topdog was $5 in 20x7 and $4.50 in 20x6. You know that the dividend paid in 20x7 was 25 cents. You can then calculate the total shareholder return. So it is the current share price less the previous year's share price, add on the current year's dividend, and then divide it by the previous year's share price, and then make it a percentage. So it is 16.66% for Topdog. Corporate governance. As you know, there is a separation between the owners and the management. Directors have a fiduciary duty to the shareholders to act in their best interests. However, over the years there have been countless corporate scandals where directors have acted unethically to inflate profits and share prices. Organizations should implement corporate governance codes of best practice. These have the following impact. Corporate governance codes increase directors' accountability. They aim to reduce the shareholders' risk due to unethical behavior. Directors' salaries should be decided by an independent remuneration committee. These codes ensure a more balanced board of directors by having non-executive directors who are independent and not involved in the daily operations of the organization. The chairman of the board of directors can never be the CEO. these roles are separate. The chairman should be an independent when they are appointed. Although corporate governance is not obliged under law, in most countries, companies usually must comply with corporate governance codes of best practice to gain a stock exchange listing. A stock exchange listing means that the company must produce financial reports annually that give detailed information about the directors' salaries and pay attention to their corporate social responsibilities. Welcome to F9 Financial Management. In this video, I will go over the financial and other objectives in not-for-profit organisations. A lot of this syllabus was covered in F5, so please refer back to F5 Performance Analysis in Not-for-Profit Organisations and the Public Sector to refresh yourself. There, I examine the qualitative nature of not-for-profit objectives and other aspects. Not-for-profit's goal is to provide for a need in society on a continuing basis and not to maximise shareholder wealth. The contributors of capital to these organisations are unlikely to get a benefit from it. This is very different from a for-profit organisation, and all the company objectives are affected by the organisation being a not-for-profit rather than a for-profit. So wealth maximisation is not important to donors, and so not an objective, but value for money and stewardship are. Not-for-profit's income is irregular and unpredictable, so achieving funding is a key objective of these organisations, as well as getting value for money. Stewardship is where money received for a certain purpose is used for that purpose, and that purpose only. For example, if a government transport department received government funding to build a road, that is where the money must be spent, not on finishing off, say, a railway station. Performance measurement is measured using financial and non-financial indicators. Non-financial data is very important in a not-for-profit to measure the achievement of non-quantifiable goals. In a traditional business, performance management is very important, and there is a motivation to undertake it for management bonuses and appraisal, as well as the good of the organisation itself. As not-for-profits often have a lot of volunteer staff, performance measurement may not be seen as a priority, or it may even be seen as a waste of time and resources. It is, however, important for the organisation's success and the achievement of its objectives.